I came up with this because I really wanted to find a better way to invest. And I think this is it.
Playing the stock market is a volatile game, but with the right tools, you just might win. Hi, I'm Rebecca Brayton and welcome to WatchMojo.com. And today we're speaking with wealth advisor John Schwinghammer about his book, Purple Chips.
It's a book that tells people how to invest in the best quality, the highest quality of stocks that are out there. And so essentially I call them purple chips because they're like the royalty of blue chip stocks.
Would you mind giving us a few examples of blue chip companies versus purple chip companies?
Blue chip companies would be names like DuPont, AT&T. The reason I don't consider those purple chips is because those, in fact, if you look at their earnings history, go back like 10 years, DuPont is actually making less money per share today than it was 10 years ago. And it's no surprise that the stock is lower than it was 10 years ago. And the same thing happens with a company like AT&T. Okay, AT&T actually has improved a little bit, but not very much. So if you look at the earnings history, they're pretty much flat line for the last 10 years. We don't want that. What we want is companies like McDonald's. Okay, McDonald's it's a beautiful earnings history. You've got a chart of earnings that like whoop, straight up. That's what you want.
Is it possible to consistently win at the stock market?
Consistently is a tough one, okay, because the stock market has a mind of its own. What you want to do is invest in the best and increase your odds of success. So I'm not saying that this is a foolproof, guaranteed way to make money because it doesn't exist, okay? But what you have to do is pick the best companies and at least you can sleep at night.
How do we pick the best stocks?
You're looking at the track record of these great companies and you're looking at earnings history. By doing a quick visual inspection of a company's earnings history, the earnings per share as I call it, you can determine whether these are companies worth investing in. And it's funny, out of all the universe of stocks, there's hundreds and hundreds of stocks out there, there's only 43 companies on the TSX that fit our criteria, okay? And on the US markets, there's 240 out of 5,000 listed companies. Okay, so that narrows the scope quite a bit, narrows the field.
Why is it so crucial to look at earnings per share?
If you were buying a business, that's the first thing you do. Okay, it doesn't matter how much sales they produce. What matters is how much earnings you produce. Stock prices are driven by earnings. Okay, if earnings go flat, your stock price is going to go flat. If earnings go down, your stock price is eventually going to make its way down too. And that's the whole thesis of this book. If you invest in companies that have rising earning profiles, that have fantastic earnings track records, your chances of making money are excellent.
Would you say it's more important to hit one big grand slam and make quite a few failures along the way?
I talk about that. That's the psychology of investing. And we're not made to withstand a series of losses. It's too hard on the psyche. If you have, 9 losing investments and then 1 home run at the end of it, it's all very nice, but you have to be there for that home run at the end. So it's just too hard morally and psychologically to withstand a series of losses.
So for someone who's new to the stock market, what kind of events can have an effect on trading?
The stock market is a very unpredictable animal, okay, and especially these days. You have companies, great companies, where stock prices get decimated because they underperform, let's say, or they change their guidance on how their business is doing. You have to be careful about those things. You don't want to be invested in stocks that have a wishy-washy history, that can change suddenly. That's why I look at pedigree. Okay, you're looking for the companies that have the best track records.
What is the trick to buying low and selling high?
Valuation. It's all about valuation. Facebook.
That's where I was going next.
Okay, Facebook, the valuation, they initially started talking about that at, I think it was 28 to 32. And I thought, okay, that's not bad, for a company that's got 1/7 of the world population following it. People might like that. But in fact, when they came out and said that the IPO would be priced at 38, I thought it was not like.
So tell us about the Facebook situation. What went wrong?
2 things. Number 1, the price of the IPO was too high. So to make money, you need someone else to buy your stock, okay? It's not gonna happen when the valuation is too high. Secondly, and more importantly, litigation. So when litigation comes up, especially in this market, forget it, game over.
Do you have anything else to tell our viewers?
People are probably going to wonder, okay, where do I find out about, the list of stocks that qualify on this? We have a website, purplechips.com. It's got everything you need to know there.
Great, thank you very much.
Thank you.